focus on what matters.
Welcome to the Future of Sustainable Investing virtual event, our final Axios event of 2021. I'm Ben Gieman, energy reporter at Axios, and I'm coming to you from our office in Arlington, Virginia. Welcome to our audiences on Facebook, YouTube, Twitter, LinkedIn, and on Axios.com. Please join the conversation today on Twitter at Axios and hashtag AxiosEvents. Over the next 30 minutes, I'll be joined by my colleague, Hope King. We'll unpack the forces driving large-scale investment in climate technology and look ahead to the ESG trends shaping the market for 2022. Our first guest is the global head of Moody's Climate Solutions, Emilie Mazzacurati, joining us from Paris, France. Emilie, how are you?
I'm good, thanks. How are you?
Doing really well. Thanks so much for being with us.
Pleasure.
Yeah, I would like to start with, I think we were both at the COP26 conference, climate conference in Glasgow. And I guess from a sort of sustainable finance and climate-friendly investment flow standpoint, I'd love to get your sense as to what extent COP26 was a success or a failure.
Well, as any COP, it was a mix of both. Without getting into the technicalities, there were some improvements and progress on some technical components. But what I will highlight as a success from my perspective is that it put climate back on the agenda in a way that COPs from the previous years hadn't. And I was also really pleased to see that a lot of the focus was around 1.5 degrees as a target rather than 2 degrees. And that is a shift that started occurring in Paris and that feels anchored, at least in the language. Now, it was also not completely a success, to put it mildly. Very insufficient commitments. It didn't go far enough. Of course, China didn't show up. This wasn't a big get-together moment the way Paris was back a few years ago. And this lack of commitment, to me, reinforces the message that governments are not ready to support the systemic changes that are needed to enable the shift to a low-carbon economy. And that can be a little discouraging.
Yeah, both from a government and from a private sector standpoint, there was an immense amount of discussion there about financial flows. And certainly there was a lot of discussion about the Glasgow Financial Alliance for Net Zero, which brings together, of course, this huge wealth of financial institutions. I guess one thing from your perspective, looking ahead, to what extent do you see the outcomes of the COP, either the formal text, but also, of course, all of the sort of side discussion and side agreements? How will that, in a tangible way, affect financial flows going forward as it relates to sustainable investment and investment in clean technologies?
Sure. Well, I'll start with the negative, just to stay on the same line of thought. This lack of policy signal is a missed opportunity to send a strong signal to market that there is a long-term commitment from governments to support the transition, and therefore that it is worth it for investors and for corporate to put their money into green investments, to start shifting some of the technologies or some of the plans they may have. So this absence of a strong signal, it means deferred investments, it means deferred capital reallocation, deferred shifts in business model for the kind of organizations that are waiting for policy or regulatory requirements to take action. Now, we also had a really strong rally from the financial sector in taking initiative and leadership over net zero commitments and net zero finance. And so there are a number of organizations who are not waiting for those policy commitments to act. So you mentioned the Glasgow Financial Alliance for Net Zero. We had over 450 firms with assets worth $130 trillion. We had 92 banks with over $66 trillion in assets that made commitment to align with net zero. And so those large influential firms are setting market standards by taking those commitments, by publicizing their own policies. And so it's not only this group of leaders, they're also going to shift the whole market because they're paving the way for middle market players who don't have the resource to do this in-house, but that can follow into the footsteps of those larger organizations.
And of course, at this point, companies of all sizes, some the biggest companies in the world, but smaller companies as well, are now making all sorts of new corporate pledges and sustainability commitments. I think we've all probably heard a lot about companies pledging to be net zero by 2050, or in some cases for some of the big tech companies, even sooner. But as you look at the kind of wealth of corporate commitments that we've seen, in your view, are they ambitious enough? And as a sort of second question to that, how can ESG-minded investors make sure that these commitments are actually being implemented once we've had these kind of splashy announcements that they now exist?
Yes, lots to unpack here. So let's start by the numbers. So we did an initial analysis of about 4,500 companies, and we found that over 40% of them have set a target of some sort. 15% total reference net zero. So we're again in the 600 range. That's not counting financial institutions. But it's really hard to quantify those targets because every company uses a different time horizon, different baseline. They might put it in idiosyncratic intensity metrics like carbon per hours worked instead of just overall greenhouse gas emissions, or there may be very little disclosure about historical emissions. So setting aside those technical aspects, we found that even the companies that have set targets are not going far enough, and that if all those companies reduced emission, they would be on track, supportive of a world going towards 2.1 degrees Celsius on average. So still well above where we want to be. And then within that group, we found that only 3% are really aligned with net zero in the short term. So by short term, I'm looking at 2030. It's really hard to look further. You start getting into guesswork and speculation. Who knows what a company will look like in 20, 30 years. So the kind of things that we run into in trying to help the market. What we know is the market wants simplicity, transparency, and they want to focus on actions. So as I mentioned, we look at the near term, 2030, because we feel like that's a more realistic time frame to assess what companies are really doing, rather than taking the risk that all actions would be deferred to 20 years down the road. The next year.
Yes, I think that's so important.
We use well-recognized public benchmarks. We try to standardize how we look at the targets, and at the end of the day, this is about really helping provide coherence and transparency in how we look at those emission reduction commitments.
Yeah, definitely. I think the technical aspects of it you mentioned are actually, tremendously important from a real world perspective, because I think it can be very difficult for people to assess what these targets mean when companies use different baseline years, for example, or different definitions of net zero or carbon neutrality. To what extent do you see a greater standardization, or the need for a greater standardization, and how can a company like Moody's help kind of bring that into being?
So I think where we can really help play a role is try to bring that transparency, that standardized type of approach, but also to the extent that we can try to prevent greenwashing by providing. So right now we have lack of transparency, lack of data, lack of comparability. We have uncertainty around technologies. We have companies saying we're going to rely on such and such technology, for example, carbon capture and storage, that may not be technically viable, commercially viable. Some of those are different level of maturity. So the type of things that we might look at over and beyond the actual targets themselves are governance. Is there board level oversight of climate risk? What's the role of the management? Is climate integrated into risk management? And we're seeing an upside in the number of companies that say they're doing that, but it's still a minority on the order of 10, 12, 13%. We're also going to look at the strategy and implementation. Where are companies putting their money? CapEx, investment in R&D? Are they investing in green technology? And how are those trends shifting over time? Because this isn't something that we're going to assess today or tomorrow. This is a long game. And investors will want to see consistency in the direction and acceleration in the level of efforts over years.
One thing I'd like to get your thoughts on that we also heard a fair amount about at COP26, and in general in discussion of sustainable finance more broadly, is to what extent that climate risk is going to be affecting the creditworthiness of companies, and how should investors approach that topic? Because there are, of course, physical risks, there are transition risks. How does Moody's see climate change affecting kind of credit ratings and creditworthiness going forward?
Sure. So how should investors approach this? seriously is my answer, because there is real risk in there. And this is something that we've put a lot of work in as a global integrated risk assessment company. Where what we're doing is embedding those climate considerations, both transition and physical risk, into our core credit risk models. We're looking at how changes in demand in energy and fossil fuels, energy prices, impacts on productivity because of heat are going to affect valuation, volatility. How is that going to affect the financial situation of the company, with a differentiated view, so that we can really help investors understand how their portfolio is going to perform at the entity level as a portfolio, and also understand how the economy is going to evolve over time.
Definitely. Well, I think we're going to make that the last word. It's a lot to chew on and a lot to look forward to in this space. So thank you so much for joining us today, Emilie.
Thanks for having me.
And next, we have a View from the Top segment with my colleague, General Manager at Axios HQ, Jordan Zaslav.
Thank you, Ben. And thank you to our sponsor, iShares, for making this conversation possible. And now, joining us from New York, the head of iShares Americas at BlackRock, Armando Senra. Welcome, Armando.
Thank you, Jordan. Great to be here.
All right, let's jump right in. So in your role, you have incredible visibility into market trends. What are you tracking in 2022?
Sure. Look, I think that we got to begin with the pandemic and the bounce back of economic activity after the COVID shock really led to more of a restart of the economy than a traditional recovery. And, we continue to have a very complex environment in our lives. I'm sure you feel the same way, but also in terms of the impact to the economy. So one of the headlines that all investors are going to keep in mind is what is happening with the pandemic, and also the impact. So one of the impacts has been inflation. That's one of the headlines that all investors are going to keep in mind. And we have seen supply chain disruptions because of COVID. We have also seen labor shortages. And of course, the fiscal stimulus has also given the economy a big boost. So the rising in inflation is one of the big themes. I think moving from a macro perspective to more what investors are doing, I would say, number one, sustainability, and that's something that I know we're going to talk more about, but more and more investors thinking and incorporating a sustainable lens as they build portfolios, as they recognize that sustainability is about investment risk and investment return. So how they were thinking about that in their portfolios and how that's driving capital allocations. That's important. And then I would finish with the rise of the self-directed investor. We have seen just this massive flow of new investors coming to the market. Here in the US, over 30 million new brokerage accounts open. I think that there's many times we overhype the idea that these new investors are just traders. The reality is that, for instance, they use ETFs to build portfolios. And I think that this is a good thing. You see more people come into the market and begin to step into investing. And that's one of the big roles that we played at iShares and that ETFs play in helping investors build portfolios.
Now, Armando, today's conversation really spotlights sustainable investing. Love to hear what you think are the forces that are shaping sustainable investing today.
Yeah, the growing understanding that sustainable investing is about investment risk and investment performance. And when you think of ESG, environmental, social, and corporate governance, those factors have a real impact in asset pricing, in capital allocations. And therefore, what is really important there is to understand that as you're building a portfolio, this is not just about your values or your preferences. This is about the outcomes that you're expecting in your portfolio and how you have to account for the impact and the opportunities that these factors will have in your portfolio. And we see that happening across the world. This is no longer a European theme. It's happening here in the US. If you look at our flows, half of our flows in sustainable ETFs are coming from the US. And again, there's also a big factor here in consumer preference. And I spoke earlier about all these new investors coming in. A big part of those new investors are millennials who are really expressing their views on how they live, what they consume, the companies that they buy, and how they build portfolios. And they want to incorporate sustainable investing in their portfolios.
Going deeper there, how has sustainable investing actually influenced investor preferences and decision making?
Yeah, we're seeing a major transformation in the global economy as the world moves to a low carbon future. And just as companies adapt through innovation, they adapt because of consumer preferences, as I mentioned earlier. They adapt because of regulations. Consumers, investors also need to adapt how they build portfolios to account for the changes in the global economy. And that can be seen in a couple of different ways. I mean, when you look at climate and in the environmental piece of ESG, you can clearly see how climate is investment risk. Climate change is investment risk. And you can see in our daily lives, the extreme weather events that we're witnessing that have really increased massively in the last few years, and the big cost that they have in the economy. In the last 5 years, over $600 billion estimated of cost because of extreme weather events. So what that's telling you is that's having an impact on the companies and the investments that you're making. So you have to account for climate risk when you're building a portfolio. Another part of that, on the opportunity side, this transformation of the global economy to a low-carbon economy, it will require $50 to $100 trillion in investable assets to really go through that transformation. So again, massive opportunity. Just to give it a relative sense, that's the equivalent to 10 Marshall Plans. So that really, again, should open the eyes of all investors that they need to be thinking about that transformation and how they take advantage and how they think of the risks in their portfolios.
And I can't let us wrap without talking about the record inflows that ETFs have seen this year. What does growth in ETFs look like across the board moving forward?
Yeah, look, I mean, like you said, we've seen tremendous growth in the ETF industry, not only at iShares, but globally in the industry. I mean, we've seen, it took us 15 years to get to 1 trillion in assets. It took us 5 years to get to 2 trillion, and about 2 years to get to 3 trillion. So just massive growth. And we believe the ETF industry is still in the early days. Global equity ETFs represent less than 10% of global equity markets. Global fixed income ETFs represent less than 2% of fixed income markets. So again, tremendous growth for the industry ahead. What I would say, if I look at 2022, a couple of big drivers of flows for the industry will be thematic investing, which already saw tremendous growth in the last couple of years, and also sustainable investing. We spoke quite a bit about sustainable investing. In the case of thematic investing, I think that this is an exciting area of growth because you're capturing themes that are relatable to the investor. So when I think of themes like electric vehicles, clean energy, infrastructure, these are themes that investors can understand, and they're looking to express their views in their investment portfolio through these themes. So they're also developing an emotional connectivity to these themes that helps them stay invested. And we know that if you stay invested for the long term, you should have better outcomes. So when I think of in the iShares line of products, when I think of, for instance, iDrive, investing in electric vehicles and autonomous driving, what you see there is you're capturing the entire value chain. You're capturing the battery producers, the vehicle producers, the sensor producers that go into cars. It really allows investors to capture that thing. Same thing with our iShares infrastructure ETF. It gives you exposure to what is happening here in the US with the passing of the infrastructure bill to take advantage of that theme. And finally, to finish in sustainable, the iShares iClean ETF gives you exposure to energy companies that are really going through that transformation and investing in renewable energy. So those are three themes, as you can see, that really capture a lot of the trends that are really impacting our lives and also the economy.
Well, Armando Senra, thank you so much for joining Axios today.
Thank you, Jordan. Great to be here.
And thank you to iShares for making today's conversation possible. And we're now going to pass it over to my colleague, Hope King. Thank you, Hope.
Thanks, Jordan. I'm Hope King, business reporter for Axios. Our final guest is the president of S&P Global Sustainable1, Dr. Richard Mattison, joining us from Edinburgh, Scotland. Hello, Dr. Mattison.
Hi, Hope. Pleasure to be here.
It's so great to have you. I want to begin with just sort of a state of play. What percentage of the world's multinationals that you're covering have a plan to encourage their partners to become and for themselves to also become net zero?
That's quite a broad definition when you include partners. So I would actually say a relatively small number, because actually the scale of industrial transformation that we're going to require is huge and will include value chains, supply chains, how you think about products, how you think about other stakeholders, how you think about even how you interact with the finance sector. So a small number, I would say, but in terms of total companies signed up to net zero pledges overall, we're past 5,000 companies and 130 trillion of assets under management now.
And what does that mean in context of how we need to get to these goals in order to come below what we agreed upon with the Paris Accords?
I think we need to get much more specific. We have a long-term roadmap. We have the equivalent of the destination plotted in the GPS, but we don't know what the route is yet. And I don't think we really have enough understanding of what the near-term plans need to look like. We don't even know what a good transition plan looks like. There is a lot of work underway on that. I think there's a never before seen scale of collaboration, in particular between banks, asset managers, and companies on really what a good transition plan looks like towards net zero. But in terms of what we can see publicly, there's actually not a huge amount right now.
So from what we do know, it's really based on voluntary reports. And according to PwC, more than 90% of S&P 500 companies have some sort of sustainability report on their own website. But we do know standard disclosures are coming, especially here in the US. What do you think are some of the main components of those disclosures?
Yeah, you have 90% of voluntary reports, but only 16% in filings. And so I think there is a big gap. And there's actually a liability gap in that context too. So I think we can expect to see, to be honest, a lot more prescription. I think we need really close definition about what we mean by transition. What do we mean by emissions disclosure, for example? What does a good target look like? How do you disclose on the different scopes of CO2 emissions? And so I think actually what we've observed over the past 5 years or so is a move from principles-based reporting to a far more prescriptive regime, which really does make very clear definitions about the areas that need to be disclosed, not least because it's that level of information that is required. And that's why we see progress being made from the accounting industry in terms of accounting standards being developed in this space. And we do expect securities regulators to be much more specific and prescriptive in their definitions.
Give me an example of what something that is prescriptive in a disclosure looks like. What does that mean?
Yeah, so for example, you might say that in the past, you might have said, please disclose your climate strategy. And in the future, you might say, please tell us your next year, 2025, 2030, and 2050 targets on reducing emissions in alignment with the Paris Agreement in accordance with science-based principles. And so that's moved from a narrative description to metrics and numbers and figures and forward-looking information that is also defined and measured. And I think that change presents a challenge, frankly, for many companies seeking to disclose on climate risks and climate opportunities. But it also requires another level of planning if we're really to do this well. Its transition to a net zero future will require a real, I wouldn't say it's a revolution, it's more of an evolution to a brand new mode of operating for many industries. And so we need to see the details.
And we know a lot of activists feel that the action has been too slow. So, maybe we do need that revolution instead of the evolution. It does take some time, according to some of these activists. But let's fast forward to that time marker that you mentioned, 2025. You've written in the past that this year, this 2025 year, will reflect a potential tipping point for net zero transition. What did you mean by that? What would be some of the worst case scenarios if today we were sitting today and this was 2025? What would that look like? And what would be some of the best case scenarios in terms of the progress that companies should have been making?
I mean, quite frankly, the worst case scenario is we've had no real world impact whatsoever on the trajectory that we are on today in terms of global warming and climate change. And so we will be beginning to see many more climate related hazards, more of the physical impacts of climate change impacting on asset valuations of companies, more geopolitical issues as well. And so that is kind of worst case. Worst case also means disclosure is all over the place. It's impossible to interpret progress from the perspective of which companies are doing well and which companies are doing poorly. It also means that it's impossible to identify whether what a company is doing is actually good or sustainable or green or in alignment with a net zero trajectory or not. And we have a lot of greenwashing. That's what worst case scenario looks like. What best case scenario looks like is really that we have clear definitions, we have clear disclosures, we have comparable disclosures that investors can really use to allocate capital. There is robustness and credibility in the processes used to gather that information and interpret that information. And that process means that the information is actually at the core of a scaled flow of capital towards sustainable outcomes, and that we are starting to see a real difference in the real world with respect to some of those climate disasters that I was talking about before.
And you've also mentioned in the past, there is also a war for talent here. I mean, we know there's a labor crunch, through the pandemic. Do we have enough people in place who can make the right changes happen within this? Really, we're just looking at a 3-year time span.
Yeah, look, I think quite frankly, I think we have many of the technologies are in place for that time horizon. Perhaps beyond, we need far more innovation, but for that time horizon, we have many of the technologies. We have proven efficiency of capital flow in certain areas where some of the technologies are actually cheaper than some of the more mainstream technologies. So we have quite a lot of information flow. We have quite a lot of skills in the marketplace. I think there is a war for talent because, frankly, at the moment, every bank and every asset manager and every pension fund and every company like ourselves is seeking a lot of talent in this space. And so there is a war for talent. But part of this is not just finding people with brand new skills who are new. It's actually ensuring that people who are making decisions and who are allocating capital are trained enough to be able to do that. And I think what we need to do is ensure that it's a balance between finding the very people with deep skill sets and deep pools of talent in that space, alongside providing the right information to those who are allocating capital in the mainstream context, and ensuring that we're not confusing those people by providing overly complex information, nor are we dumbing it down so that we're greenwashing. So I think when I think about talent, it's about deep skill sets, yes, but it's also about ensuring that you're educating the organization sufficiently that across the board, everybody is making the right set of decisions, and that in terms of the information flow, we are providing the right set of information to the marketplace that is at the appropriate level to allocate capital.
Transitions are tricky. Huge shifts like this are going to be expensive. We're already seeing in Europe soaring energy prices. What does this tell us about what the road to net zero will look like?
Look, I think it is an often repeated narrative that transitions might be expensive, and this transition could be very expensive. But frankly, we have two paths forward: a potentially a higher set of costs associated with a transition, and an even higher cost associated with a not transition. In other words, higher costs associated with climate-related physical disasters, hazards impacting on us, and mass disruption globally. I think it's a fallacy to say that we will either continue with business as usual or have transition. Those are not the two options. The two options are we transition or we don't, in which case the cost will be higher. So I think we need to balance that, and we need to make wise investment decisions in that context. And also, I would challenge the thesis that transition is always going to be more expensive. It may provide actually greater economic growth than the current business as usual.
And looking forward to 2022, what are some main ESG themes that you're watching?
So for us, transition, what is a good transition plan? How do we interpret that? How do we get the right intelligence on that? That's a key theme. Nature. I am a member of the Task Force on Nature-related Financial Disclosures. We can expect to see quite a lot on nature risks, because you can't be net zero without being net positive. And I think when it comes to the broader ESG agenda, I think we will see the need for a lot more transparency on exactly ESG rating or a score designed to be, and we'll be working a lot on that too. So we're very excited about 2022. We think this will be a very transformational year. Yes, I think those are some of the key themes.
Dr. Mattison, thank you so much for joining Axios.
Thanks so much, Hope. It's been an absolute pleasure.
Thank you all for joining this afternoon for another virtual conversation, which has made everyone smarter, faster. And thank you to our viewers who have tuned into our events throughout 2021. To watch any you may have missed, visit axios.com/events. To sign up for the Axios Closer or Generate newsletters, visit axios.com/newsletters or on the Axios app. Thank you all for joining, and we'll see you on axios.com.